Hey guys, Joseph Henson here with Henson CPA Group. It is the week before Christmas, and I hope you guys are ready for next week. And I hope you're going to take some time to spend with your family, need a little bit of rest. This week, we're going to talk about tax planning for 2026, starting the year on the right foot. Again, I'm Joseph Henson, CPA with Henson CPA Group. I thank you guys for joining me today, and we're going to just dive right in. Why early tax planning matters. Why can't I just wait until April 15th? Why can't I worry about this later? Starting tax planning before the year begins will help you prevent surprises. Being proactive and having proactive planning can save thousands, tens of thousands by maximizing your deductions, timing your income and expenses, and optimizing retirement contributions. If you ever wondered, how much do I want to put into a traditional, how much into a Roth, how can I recognize more expenses this year, look for a little bit of hurt versus help. What needs to happen for deductions? Is it better for this meals and entertainment? Or what if I start advertising with the schools a little bit? That's the things you want to start doing now and yesterday, not just next year for the prior year. And waiting until year end often will limit your options. You don't get as many choices or chances later on. Review your entity structure. This is one of the things you need to do. You want to reevaluate your clinic's legal structure. Are you an S Corp? Are you an LLC, or are you a partnership? There are benefits to all of these, and sometimes you should really start reviewing this. If you were a partnership and now you bought out your partners, you're no longer a partnership. You're not filing a 1065. You need to file a Schedule C potentially on your LLC or an 1120S if you made an election to be an S Corp. Entity structure will have a lot of effects outside of what you typically think they should. It does affect your payroll taxes. It affects if you're going to be taking owner distributions or draws, and also some deduction opportunities that can happen depending on your structure. Minor changes now can have big tax savings in 2026. 2026, it might be too late. But now is the time to start looking at it to say what is actually going to happen. Income timing strategies. You want to see if you can accelerate or defer income to optimize your taxable income. Sometimes this is hard with veterinarians, and there are some tips you can have. As a veterinary clinic, timing the invoices and payments. If you have folks on December 31st that you've been working with and they are fine, and you know that they're going to pay, and you offer them a little bit of accounts payable for you instead of only taking scratch pay or instead of only taking care credit, delaying that income is okay if you're doing the cash basis. And then even with paying on rent, does it make sense from a cash basis standpoint to prepay some rent, to prepay some utilities, to recognize that now, understanding next year might be a different situation? Can you prepay a vendor if you need to, or can you prepay a lawyer or an accountant? Those are all things you can start to look at if you want to reduce your taxable income. Planning for major procedures near year end, but knowing that's not going to be collected until 1/1, 1/5, 1/10 can actually help you. If you all of a sudden have a $5,000 procedure because it's extremely complex, but knowing that, hey, I'm earning it now, but I'm going to delay that. It's okay if they pay me a little later. That is completely legal and okay if you're on the cash basis. This ensures you keep your effective tax rate as low as legally possible. We're not trying to get rid of taxes. We're trying to play the game of optimizing your tax strategy. Expense planning and deductions. Review your recurring expenses and capital purchases. Do you have upgrades for equipment that need to happen now? Are there any staff training or certifications you can pay for now that your employees can do later? That's something great. We want to invest in our employees in every way possible. You have veterinarians, you guys have to take continuing education as it is. Is there some certificate to get your vet tech to be a registered vet tech, or this or that? And are there any software subscriptions you've really been thinking about and paying monthly that now you can convert that to yearly and get a whole deduction for the next year today? And then you get down to, with the equipment upgrades, using Section 179 deductions on the tax return. or 100% bonus depreciation. There's goods and there's bads. It's sometimes one of those things you have to kind of think through and say what makes sense. Deductible expenses now will lower taxes next year. Again, deductible expenses now can lower your taxes come April 15th. Retirement and owner compensation planning. Let's maximize contributions to your SEP IRA, your solo 401k, or your defined benefits plan. This lets you put away a lot of money. It's tax later on, tax deductible now, tax free later, or it will grow. You'll be taxed on it later as long as you're optimizing traditional versus Roth. There is a line here you have to be aware of. Do you want to pay tax now, or do you believe you'll be in a lower effective tax bracket later? You also want to align your owner's salary and distributions if you are an S Corp. What does that mean? How much should you be making? What is your reasonable compensation? Okay, great. Are you paying yourself, let's say that's $100,000 based on a reasonable comp study that we've done for you, and you're paying yourself $150,000. Let's reduce your taxable W-2 wage to $100,000 so that $50,000 will save you $7,500 in taxes later on. You want to plan this out. You don't want to just say, oh, it's fine, I've always paid myself this, or oh, it's fine, this person makes that, I'll do the same. Your situation is different than your coworker's situation, than the peer down the street. Your situation is unique because you have expertise they might not, but they might also have expertise. If they're a high cost surgeon, they might make more than a general practicing DVM. That's okay. If you are a veterinarian, you make great money for a lot of work. We want to optimize that so that you also don't have to pay as much in taxes. Planning early will ensure you take full advantage of contribution limits, payroll tax efficiencies, and it will help you meet your personal retirement goals. If you're not working with a financial advisor as well as your CPA, today's the day to start. If you need recommendations for that, feel free to let me know. I've worked with a lot of financial advisors in this veterinarian industry and know different ones that I can refer you to. Tax credits and incentives. Small business credits that are often overlooked are work opportunity tax credits, the employee retention credits, if it's applicable, and research or training related credits. Have you developed a new system or a new piece of technology that can streamline what veterinarians are doing? Does that mean it should be in research and development costs? We want to look at that. We want to talk through it because a lot of those have tax credits. I apologize. Proper planning ensures you don't leave money on the table. Planning for it now makes it easier so that you know exactly what's going into this and can take advantage of reducing your taxable income by an appropriate amount. Tax planning timeline for 2026. This is saying during 2026, if you start planning for 2026 today, what makes sense? For income timing, October, November, December, we want to make sure we can potentially defer some of that income until January. There's emergencies, there's major things, but it's okay. If you can collect January 2027, those 3 months are the ones you want to look at. Do you need to front load or back load? Did you have a big expense this year and you want to make as much money as possible? Well, let's make sure we collect as much as possible in those last 3 months. Retirement contributions, do this systematically. You have people try to time the market. If you figure out how to time the market and make a killing, let me know. It's not something most people can do. Just dollar cost averaging throughout the year so you know what needs to happen. Then you have your estimated tax payments. April, June, September, January. You want to make estimated tax payments so that come April of next year, 2026, 2027, you all of a sudden don't get hit with a $50,000 tax bill. And then expense planning. Do you need new equipment? Let's look at July. Let's look at August. Let's look at September and make sure we're planning this along the time where it makes sense. If you don't need the equipment and you're just like, hey, but I want to save on money on taxes, great. I'm not going to push that unless it's my ultrasound machine is old, my surgery table needs replaced, the hydraulic lift on it's not working anymore. get that stuff, but don't just buy it to reduce taxable income, because then you're just throwing good money away, even if it does help reduce it. You don't get 100% deduction on all that. You're going to have depreciation anyway. Quarterly review and tracking. You can't just tax plan once a year. You have to do this at least quarterly. So schedule that quarterly review with your CPA. Compare your actual income versus projections. If you were projecting $1.2 million in gross income for the year, and all of a sudden come April, you realize for January, February, March, you're at $450,000, do you need to adjust that projection and realize, hey, right now, based on that $450,000, I'm actually looking at closer to $1.8 million in revenue if that continues. That's stuff you need to know. And you want to make sure you can adjust the estimated tax payments and track your deductions and payroll. Are your books reconciled? Have you actually paid attention to what's happening? I harp on it a lot. If your balance sheet isn't working, your income statement isn't working, and vice versa. Your cash flow statement tells you nothing. But staying on top of it, your expenses ensures there are no surprises come April 2027. I know I came at this one really fast today, and it's because I hit on this all the time, but I want you guys to understand now is the time to tax plan for 2026. 2025 is about over. We have just a little bit of time left, but now is the time to really start focusing on what we can do to set you up for success in 2026. And if you want help setting up your 2026 tax plan and making sure your veterinary clinic starts the year with clarity and savings, come over and talk to us here at Henson CPA Group. Again, I'm Joseph Henson CPA. My email is Joseph, 2 E's, at hensoncpagroup.com. You can also find us at hensoncpagroup.com. Click on the link specifically for you veterinarians and let us know and let us get to work for you. I do have a link below on this Facebook Live, but I hope you guys have a great Christmas, and I hope you get some downtime with your family.